Inflation has been a topic of concern for a while, and interest rates are expected to be on the rise. But what does that mean for investors? Let's take a look. Welcome to another episode of Money Matters. Interest rates are usually foreseen. Central banks make fairly clear signals to the market that interest rate rises are to be expected. Some investors are concerned that interest rate rises signal a downturn for the market as the cost of borrowing increases and the rate hikes are a headwind to economic expansion. This is a valid point in theory, but history shows us that rising rates do not have a predictable impact on markets that you can use to effectively time the market. Rising rates in isolation have no consistent impact on the markets. There are other factors at play which also have an impact on the markets. It is important to remember that no one factor is solely responsible for market movements. It's always a combination of factors that drive markets to act the way they do. Now, we have to give this topic some context here. Not all market participants have the same objective in mind. More specifically, not all market participants have the same time horizon. I've said it time and time again, and I'll say it here as well. Most of the information what we are bombarded with on a daily basis is concerned with the short term. Unless you are a trader timing in and out of the markets to make gains, you need to apply a filter to this information. We need not concern ourselves with most of the information that will undoubtedly, whether we care to admit it or not, affect our investment mindset and encourage us to make simple and repeated investment mistakes. But back to the topic. Market prices have priced in any expected interest rate hikes. The key word here is expected. If the central banks unexpectedly increase rates quicker than what the market expects, the market may react to this unexpected news. In theory at least, and on the rate hike alone, markets will react negatively to an unexpected rate hike, or on rates increasing faster than what the market expected. But remember, that's in the short term. On the contrary, rate hikes may be a positive signal that the economy is expanding quicker than expected. Businesses are growing, consumption is strong, and there's enough flow of capital in the system to no longer require rates to be so low. But like I said earlier, many factors are at play, and it depends on how the markets read the situation. Overall, investors need not be overly concerned with rate hikes, especially coming from such a low base that we are in at the moment. The central banks have made clear signals that these rate hikes are coming, and we knew this was the case. We need to return to more normal rates so that central banks have the tools to tackle the next negative event on the economy. How can rates be reduced if we're already at near zero? I would hope that markets see this as a return to the norm and signalling that the economy can stand on its own 2 feet whilst cutting back on fiscal stimulus. Investors should maintain their portfolios. Better still, investors should invest their stimulus checks, invest their consumption vouchers, and positively affect their investments that way. We cannot affect what the markets do, but we can to some degree affect our portfolio performance. But even more so, the other sides to the investment triangle are the length of time we are invested for and, more obviously, how much we put into our portfolios. So, don't let rising interest rates put fear into you. Remain steadfast as we expect to see interest rates to rise, and ensure you continue to make contributions into your portfolios. Thank you for joining me on this episode. Let me know what other topics you would like to hear about in future videos. If you liked the video, smash the like button, subscribe, and I'll see you in the next episode of Money Matters.